So let's say that I get my tax bill and I know that I have to $50,000 of quarterlies I have to set aside. Yep. Okay. So what do I do next?
Well, there's 13 weeks in every single quarter. So if I have to pay $50,000 every 13 weeks, that comes out to me having to set aside approximately $38.50 per week.
Okay.
So my advice to clients is make your estimated tax. Number one, have a separate account, right? You have your wealth building account, you have your business checking account, your business savings. You should also have your tax account. Okay. And now,
so
let's say my quarterly estimates are $50,000, like you said. Now every week I can just do an automatic transfer right from the business checking to the tax account, so that at the end of each quarter, $50,000 is there.
Yes.
That's the easiest way to do it in a perfect world.
Yeah. So, but I think what you had mentioned is that, in our system, we typically have people set up like what we call 4 quote unquote profit accounts. The wealth building, the wealth storage account, which is their owner compensation that goes to them outside of the business, but it's a bill of the business. That is for the creation of multiple income sources. They have a business expansion account where 3 to 5% of business revenues go. They have a business savings account where 3 to 5% of revenues go. And then they have a tax account that, I guess when you add up the percentages, what does it usually end up being a year? I think from what I've seen, it's usually about 3 or 5% of revenues.
Yeah, that's probably pretty fair. I mean, it's going to vary quite a bit based on your margins, but I think that's probably pretty fair.
Yeah. So you have to put these things in as requirements. Otherwise, because that obviously puts the correct demand of income on the business. And if you don't, then what ends up happening, I mean, let's say at the end of the year, when someone says I have to pay $300,000 or I have to pay $100,000 of taxes because it said I made $300,000 of profit, but I don't have $300,000 sitting in my business checking account.
No, you don't, because your profit is, it consists of multiple things, right? Your profit consists of, number one, let's say 300,000 is your profit. Okay. What did you draw out? Because all owner draws are you taking a portion of the profit randomly throughout the year. So owner draws, savings, if you're following our plan and you're doing your wealth building account, that's part of your profit.
Yep.
Your tax payments are part of your profit. Your debt payments are part of your profit. Debt is not a deductible expense generally. It's paid out of profits.
Yeah.
And then lastly, money that's just sitting in a business checking account, your working capital. You're taxed on it whether you pull it out as a draw or not.
Yeah.
So just because you made $300,000 of profit doesn't mean you had $300,000 of spendable money go through your personal checking account where you could use it for vacations and groceries.
That's correct. So I think that's why a lot of owners will then just, when they get their tax bill, they'll just usually write a check from the business.
Yep, exactly.
Yeah. To be able to handle that. And that, sometimes they look at their business accounts and are like, oh my God, I had to, eat up all my money to go to my taxes. But I think if the easier thing would have been just to set up a separate account for where that money's going to go. That does 2 things. Number one is it assigns a purpose to money. And that way, the purpose is there. I have to make money in the business to cover my personal tax liability. It's a bill.
Yeah, it is.
You have to make it a bill. You have to make it a bill. And then the second thing is that it separates the money out so that it's not just like in this lump sum of your business checking account where money just tends to evaporate and get spent at some point in time.
And I think it's important to mention when we say this, like if you're an owner and your profit goes from 100,000 a year to 600,000 in the span of 365 days, even if you follow your quarterlies to a T and save for taxes, you're going to get hit with a big check that's due because your quarterlies were based on you making 100K and you made 6 times that. But most practice owners, year to year, their income is somewhat stable. That's a pretty rare situation for a jump that large. It certainly happens, but it's generally, I would say, within 10%. So yeah.
Well, I think a good growth rate for most practices, if they're doing, an average of maybe 10% growth a year, that's like 30% on a 3-year rolling period or something like that, a little bit more. That's pretty good.
Oh yeah.
That's pretty good. So a 10% growth in receipts, if I'm doing a million, okay, and I'm at a 20% profit margin, that's 200,000 on a million, right?